Right, so welcome to chapter 2. So, building upon what we looked at in chapter 1, let's start, putting everything together a little more into what Forex trading is about, terminologies, and all the little things that you need to be familiarized with. So we're going to be looking at the introduction to trading here. Now, for lesson 1, we're going to be going through currency pairs, indices, pips, lot size, leverage, and all of these terminologies that you will encounter in your trading journey. Now, right here on the screen, what I have is, a currency pair, which is the euro dollar. So what you have on the left is, called the base currency, and then what you have on the right is called the quoted currency. Okay. Now, we're going to be looking more into this, but essentially the currency pair, as you have on the right of the equality sign, is that when you're selling, what you're selling is that you're selling what is on the right. Okay, so you sell USD, that's the dollar, and then when you're buying what is on the left, and that is the euro. The euro essentially. So we're going to see more of that even as we continue. Now, it's very important that we learn all of these languages, and that's why this is, of course, the basics, to just build that understanding of the basics of trading essentially, and then when you can market, what you should expect and what you should see. Now, like I mentioned earlier, you could see that when you're selling what is on the right, and then when you're buying what is on the left. In other words, when you're selling, you're simply saying the US dollar is getting stronger, so you're selling euro USD, and then when you're buying, essentially you're saying that the euro is getting stronger, and then you buy euro USD. Now, what is a base and a quote currency? A base currency is simply the first currency listed in a forex pair, like we have above there, just above here rather. So this is the base currency, and then what you have, on the right is the quoted currency. So essentially, forex trading always, involves selling one currency in order to buy another one, which is why it is quoted in pairs, right? So the price of a forex pair is how much one unit of the base currency is worth in the quoted pair. So each currency in the pair is listed as a three-letter code, so which tends to be formed of two letters that stand for the region, and then one standing for the currency itself. For example, the euro dollar, it's a currency pair that involves buying the euro and selling the dollar. All right, so for example, the euro is the base currency and the USD is the quote currency. So if euro dollar is traded at 135,361, then 1 euro is worth that particular amount of money. That's simply the meaning. So to keep things ordered, most providers split pairs into the following categories. We have what is called the major pairs. So the major pairs, your euro USD, USD JPY, pound USD, USD Swiss, franc USD card, and then Aussie USD. So these are called the major pairs. We also have the minor pairs. So for the minor pairs, these are usually pairs that do not necessarily include the US dollar. So you have euro pound, you have euro Swiss, you have euro JPY. These are called minor pairs. And then there are also exotic pairs. So these exotic pairs usually belong to smaller countries, so the volatility in terms of trading it is usually low. So you have here USD, the Polish zloty, I hope that's how it's pronounced, and then you have pounds and the Mexican peso, and then on and on like that. Now, this is what we have in currency pairs, so you just have to be familiar with this just in case. Of course, this is a basic, so this is assuming that you have no knowledge of what a currency pair is. So this is essentially what a currency pair is. Now, still continuing on this, we have the base currency, and then we have the counter currency or the quoted currency, as you see here on the screen. And I've also already explained this, but one thing to pay attention to here is also what is called the pips. So the pips is essentially the difference between the base currency and the quoted currency or the counter currency. So you can see here, when you subtract this base currency from the counter currency or the quoted currency, you get two left, okay, and that's called pips. And those, the two pips, is also referred to as a spread. Essentially, the difference between the base currency and the quoted or counter currency is called the spread, or it's called the spread, which is calculated in pips, and it's a simple subtraction to give you that. Now, learning the language of FX is super important, but I can also tell you that you may discover that when you start trading, this may not necessarily be things that you'll be bothered about, especially base currency, quoted currency. It's really not an important information in the practicals of trade, and I'll explain why that is the case. But it's very important to be able to understand all of these things, so you're not just trading ignorantly and all. Now, the ask, an ask or offer is the lowest price at which you're willing to buy a currency. So, for example, if you place an ask price of 13991 for JPB, that's pound, then the figure mentioned is the lowest that you're willing to pay for a pound in USD. The ask price is generally greater than the bid price. Okay, so from the ask price, you can tell that that's the quoted or the counter currency, and then the bid price is the base currency. Now, a bid is the price at which you're willing to sell a currency. So a market making a given currency is responsible for continuously putting out bids in response to buyer queries. While they're generally lower than ask prices, in instances where demand is great, bid prices can be higher than ask prices. Now, let's talk about bear market. So bear market essentially is one in which the prices decline among currencies. So for example, when Euro USD is selling hard, you can see, okay, the euro is declining in value, but the USD is actually gaining more strength, right? So bear market, So bear markets signify a market downtrend and are the result of depressing economic fundamentals or catastrophic events such as a financial crisis or a natural disaster. Okay, now we have also what's called the bull market. So the bull market is one in which prices increase, for currencies, okay, for all currencies, for example, or for stocks. When things are going up, we say that's a bull market, and then when it's going down, we say that's a bearish market. Okay, now, so bull markets signify a market uptrend and are the result of optimistic news about the global economy. Now, that said, let's look at leverage. Now, what is leverage in trading? Now, leverage is the use of borrowed capital to multiply returns. So the Forex market is characterized by high leverages, and traders often use these leverages to boost their positions. And I'll explain what this is. So you can have leverage sometimes from 1 to 30, 1 to 50, 1 to 100, 1 to 1,000, 1 to unlimited. It simply just says put this little amount of money, but we're going to allow you to trade a large chunk of money, based on the little that you've put forward. That's called leverage. And you discover that this is something that you use all the time in your trading. Now, a trader might put up just $1,000 with your own capital and borrow $9,000 from your broker to bet against the euro in a trade against the JPY. Since they have used very little of their own capital, the trader stands to make significant profits if the trade goes in the correct direction. Of course, if the trade goes in the other direction, you're also going to face a lot of risk. Okay? Now, this is just an example of what leverage is about. So you have here 1 to 100. So you can see here that you have 100,000 for 1,000. So let's say you put 1,000 forward. 1 to 100 simply means your 1,000 will be multiplied by 100, and now you have $100,000 to do or to carry out your trade, right? Now let's talk about lot size. Now lot size, simply it's a concept that currencies, crypto or whatever is used to trade, all of this pairs. Okay, so there are standard lot sizes and then a variation of so much more. Now let's talk about margin. Margin is the money set aside in an account for a currency trade. Margin money helps assure the broker that the trader will remain solvent and be able to meet monetary obligations even if the trade does not go their way. So the amount of margin depends on the trader and the customer. The customer balance over a period of time. So margin is used in tandem with leverage for trades in the Forex market. Okay. Now, still on currency pairs indices, pips, lot size, etc. So what we have there, for example, it's the JPB USD, the pound USD. And you can see here the calculation of difference is simply just 1 pip. Okay, now we also have here Euro JPY. You can see how it's also calculated, just 1 pip difference between the previous price and the current price. Now pips are the units used to measure measurement. Wow, to measure movement. Okay, yeah, in the forex market. So a forex pip is usually equivalent to 1 digit movement in the fourth decimal place of a currency pair. So if JPB USD moves from 135361 to 135351, then it has moved a single pip. Okay, so the decimal places shown after the pip are called transactional pips, or sometimes pipettes. Now, the exception to this rule is when the code currency is listed in much smaller denominations, when the most notable example being the Japanese yen. So here, a movement in the second decimal place constitutes a single pip. So if Euro JPY moves from this to this, again, it has moved a single pip. Okay. Now, base currency and counter currency, we've seen this already. Now, on spread, a spread is simply the difference between the bid price and the ask price. I think I said that for bureaucracy. So, Forex traders do not charge commissions. They make money through spread. So, the size of the spread is influenced by many factors. Some of them are the size of your trade, the demand for the currency, and its volatility. Now let's look at lesson 2, trading sessions. Now, what are the trading sessions? You have London, you have New York, you have Asia session, and it goes on and on like that. So New York, of course, sort of interfacing with Sydney. So you have that. So that's the trading sessions, or those are the trading sessions, that are there. Now, it's important to know all of this because at the end of the day, you may discover that, I'm very good trading Asia session, or maybe just London, or maybe New York session. So now it's time to learn about the different Forex trading sessions. It's important that trader make market is open 247 a day, and that nothing, but that doesn't mean it's always active the entire day. Now, you can make money trading when the market moves up, and you can also make money when the market moves down, but you will have a very difficult time trying to make money when the market doesn't move at all. Historically, the forex market has 3 peak trading sessions. Traders often focus on one of these 3 trading sessions rather than attempt to trade the markets 247 per day. This is known as a Forex 3-session payment. These sessions consist of the Asian, European, and North American sessions, which are also called Tokyo, London, and New York sessions. Okay, now there are 4 trading sessions in the Forex market. So 1, Sydney, which is open from 9 p.m. to 6 a.m. That's UTC time. You can do the math. And then Tokyo opens by 12 a.m. to 9 a.m. That's UTC. GMT, that'll be by 1. And then London session is open from 7 a.m. to 4 p.m. UTC/GMT. So these times are very important for you to know because these are really the sessions that control the market. Then we also have the New York session. So the New York session is also open from 1 p.m. To 10 p.m. to 10 p.m. Okay, so that is that for that. Now, you can also use the volatility tool to also determine when is the best time to trade and all of that. If you want to trade based on volume, if there's nothing happening, you don't trade. And also, so here you have the volatility tool, which you can actually use. Check it out if you want to. Okay, so that is that. Now, lesson 3, technical versus fundamental analysis. Now, this is something that lots of people fight over again and again and again and again. It's unbelievable. Now, on the one hand, you have technical analysis. On the other hand, you have fundamental analysis. So for technical analysis, focus on price action charts. Draw the charts, focus on the price, wait until price gets there. We also have indicators. So indicators also, there are people who trade based off of indicators, purely indicators. And then we have oscillators. So all of this, are things that some people use, to trade, right? To carry out the technical analysis. On the other hand, we have the fundamental analysis. So for this one, what affects it is company analysis, industry analysis, microeconomic conditions, future profit, outlook. So it is very important that, we take note of this. Okay, that these, are the things that, determine technical analysis and fundamental analysis. So for fundamentals, you have company analysis, industry analysis, and all of these things, macroeconomics, that influence, decision making. On the other hand, technical analysis, just pure price action, no indicators or use of indicators sometimes, utilized by so many people. So the two main schools essentially of technical analysis are fundamental analysis, and then secondly, technical analysis. So technical first, fundamental analysis second. Okay, now let's explore more what the difference is between two types of traders and which pieces of information forex trades in particular tend to look at, and how technical and fundamental analysis can be used together. Now, technical analysis looks at the price movement of a currency pair and uses this data to attempt to predict future price movements. Now, fundamental analysis, on the other hand, looks at economic and financial records that influence a currency pair. Now, in history, you remember Brexit. Brexit was a bid of the UK to pull out of the European Union, and I can tell you that so many are, so many persons, made profits, and also some persons took hits during Brexit because it provided a lot of volatility, for traders to cash in. Now, I'm not sure why I have this technical versus fundamental analysis. So for this one, this is just a table that shows, the difference. So for technical analysis, you have forex price movements using chart patterns, price action, short, medium, and long term, then chart analysis. And then for fundamental analysis, usually you would have the economic data used to establish value or target, inflation, GDP, interest rate, etc. Medium and long term, economic and statistical, analysis. All right, now it is indeed $1 million question, and throughout your journey as an inspiring trader, you will find strong advocates for each of the analysis. Okay, now for us at Paruto Capital, we learn heavily towards technical analysis, while we keep our eyes out on the on the forex calendar for major fundamental news that can affect our position in the market. Okay, so now do not ignore fundamental analysis as you build your technical analysis skills. Both are super important to building a well-rounded trading skill set. Okay, now 4 types of trading styles. You have day trading, scalping, swing, position. So these are all types of trading types. So you have the scalper, you have the position trader, you have the wing trader, you have the day trader. So here, let's just go through this. Okay, so we've already pronounced this. Now, scalpers hold on to a few seconds to throw to a few minutes at the most. Is the type of event, is a type of forex trading style in which a forex trader opens and closes positions in very short periods of time, sometimes 5 minutes, 10 minutes, 15 minutes. The goal of profiting from minor market fluctuations, in currency pairs prices. Now, types of trading strategies: day, scalping, swing, position, whatever. Now, day trading is style of format trading, which okay, so day trading. So day trading, basically you trade within the day, you're done. A few hours, you're done. Okay, now the day trading strategy, also known as intraday trading, is one of the most popular trading strategies to trade forex and other financial assets. Okay, now types of trading strategies: day, scalping, continuation. So we have swing trading, the style where trading in which a trader attempts to make profits by holding a position open for several days, usually 2 to 5 trading days. Swing traders usually use trend trading based on market conditions and industry experts, and try to capture wide price fluctuations than day trades. Okay, now as a swing trader, swing trading is a popular trading strategy among many, as it does involve effort and a high level of consecration of scalping and intraday trading. Now, position trading is a long term, position where you just have people enter a position and they hold it sometimes for weeks to months and all of that. So that's position, sizing, or trading. So a position and holding it for a long period of time until weeks, usually weeks, months, and even events. You know, so by nature, position traders are trend followers, and they try to make decisions by analyzing the broader market picture of a certain asset selector or analysis. Now, it is low frequency trading style, and position traders avoid, they avoid volatility but favor established trends on long term ahead. Okay. Now, in summary and wrapping up, no matter what your style of trading is, no matter what you choose, you have to make sure that it is truly your personality. Okay, not just what somebody says or what somebody's saying. Now, consequently, changing trading style can lead to trouble, and it's a surefire way to blowing accounts. Okay. So that is it, ladies and gentlemen, for chapter 2. And I want to believe you've picked something from this. Please write down, the things you've picked. And as we return, we'll go to chapter 3 and fire on. And that's going to be the last chapter in the basics course. So, hey, see you in chapter 3. Bye-bye and cheers.